Okay, this is the fourth of 5 recordings on Chapter 11. So we're going to talk about depletion. Depletion is the allocation of costs to when you have natural resources. So the things you have to think about, we're going to completely remove or consume the asset, and the asset can only be replaced by an act of nature. So we're going to allocate the cost associated with the natural resources. We can allocate it all the way down to zero, but in some cases, like timber, you can increase the value of it by replanting. So we have to establish the depletion base, so the acquisition costs, any exploration costs, development costs, and the present value of restoration costs that have to be done in the future. So if it's a mining site, they're required to put it back to the state it was in prior to the mining. So they have to figure out what those costs will be when they're done with the mining and then calculate the present value of that today, and that becomes part of the value of the natural resource, the cost of the natural resource. Usually they're using a units production, so ABC, because it's generally easier for them to figure out how many units they expect to extract. And this, again, is an estimate, and it can change as they get into the process further. All right, here's an example. So this company acquired the rights for 1,000 acres to mine for gold. They're paying $50,000 to lease the land. They're going to pay $100,000 to explore it, and they have intangible development costs of $850,000 to open it. So they've got $1 million spent on this, and they're expecting to get 100,000 ounces of gold. So they will put the million in the numerator, put the ounces in the denominator, and come up with a per ounce cost. So if they extract 25,000 ounces in the first year, they will deplete the gold mine by 250,000. So one way they can do this is put it into inventory, because now they have gold to sell, and decrease directly the value of the natural resource. The other way they can do it is they can, again, debit inventory and record an accumulated depletion account. And then they show the original cost and how much of it has been extracted or how much has been processed to date. So that might be the way they decide to record it. They have to estimate the recoverable resources, and that estimate often changes as they're doing the mining or the lumber activities. So it's the same process when you have changes in estimates for depreciation. You have to revise the depreciation rate. It's done on a prospective basis. You take what you have that's undepleted to date and then apply the new expected units to be recovered. So here's an example. We have a coal mine that they paid $400,000 for the land, $100,000 in development costs, and they have an obligation to restore the property after they're done mining. So, and that's going to cost them some amount of money in the future. The present value of that is $80,000. So these are our costs. And it has a salvage value, they think, of $160,000. So we're going to add these together, so we'll have 580, and then we take out the salvage value and divide it by the expected number of units. So it's 400,000, 100,000, 80,000. This is the salvage value, and the units are 4,000. So it's $105 per ton. If we remove 700 tons, we would deplete $73,500. When you have a company that's natural resources, is extracting natural resources, you often come into an issue where you'll have liquidating dividends. And what this is, because there's revisions often to the number of units that are going to be extracted, you may run into a situation where when they're paying dividends to the investors, they end up becoming liquidating dividends. And a liquidating dividend is when you're paying out more in dividend than you have in the retained earnings account. So in this example, Callahan Mining has retained earnings of $1,650,000, and we're paying dividends of $3 million. So usually when you pay a dividend, you reduce retained earnings for the amount and then have the cash or the dividend payable. But in this case, we only have retained earnings of $1.65 million. So we can reduce all the retained earnings. The difference we need is going to come out of the paid-in capital in excess of par. So they do make the cash payment, but they've paid out all of the retained earnings, and they have additional amount that has to be reduced, so it will be a reduction of the paid-in capital. So this amount of the dividend they receive will not be taxed to the investors because it's a return of investment. There's a big controversy about depletion in the oil and gas industry. They have two concepts that are used. One is the full cost concept, and that basically says all cost of drilling is capitalized, whether it's a successful well or not. And you will then you will deplete all those costs across the successful wells. A successful efforts concept says that you only capitalize the cost of drilling associated with the successful wells. And the wells that are not successful, those costs are expensed, and you don't ever capitalize them. And so it changes what they're reporting as the cost per unit produced. Okay.